Hello, everyone. It's Ted Bauman here, editor of the Bauman Letter of Bauman Daily, and this is your Friday Bauman Daily video. I have a lot to cover today, so I'm going to get right to it. I want to start with a question from Suraj. Suraj says, I have one question from what I understood. Bond yields rise when people sell bonds due to inflation fear, which means they could actually get negative interest rates on bonds. But you also said high yield on bonds makes it lucrative to invest in rather than in the stock market, and especially in growth stocks as discounting factors increase for companies' future earnings. This is sounding contradictory to me. Please explain. I watch your videos regularly. Suraj, thanks very much. It's all a question of equilibrium. The fact that people are buying and selling bonds, it reflects the fact that some people want to hold bonds when they have higher yields and some people don't. For example, a lot of foreign currency traders, for example, if you're a Japanese bondholder, right now you're getting about 0.7% on Japanese government bonds. And of course, you have to take into account the potential for foreign exchange changes in terms of the value of the yen, all that sort of stuff. Well, right now, holding a US denominated treasury at 1.5% is a pretty good deal because it means that that's giving you additional income, and also it's hedging against any changes in the yen. So that means that there could be a demand for US bonds coming from those kind of people at the same time that other people are trying to get rid of them. So it really all comes down to a question of equilibrium and who wants to hold high yielding bonds and who doesn't. And the whole point is that if we're looking at the question of inflation, then all other things being equal, then we'll probably find equilibrium at a higher yield than we would elsewhere. So it's not an either or. It's not that everybody wants to hold them or not hold them at a given interest rate. There's an equilibrium question. So let's talk about the question of inflation. Here's a chart that shows a common signal of inflation. I got this from the folks over at Investors Business Daily. It's the copper price priced in gold, basically. And what it shows is that it's often the case that when inflation is expected by the market, you get an increase in the price of copper relative to gold. And it's fairly obvious why, because copper is an industrial metal. It's used when the economy is going well. It tends to be in demand. And then, of course, gold has the opposite. When the economy is going well, people don't want to hold it because they want to be in stocks and commodities that are going to rise in value, gold being more of an inflation hedge. So you look down at around 2017 and you see there was an increase in inflation expectations. And right there in the top, you see that copper price in gold went up, and we're seeing that now. So the real question is, will this, first of all, is this realistic? Yes, I think short-term inflation is realistic. I've said so already. The question is whether it is sustainable structurally over the long term. The answer there is no. And I think the market agrees with me that we're not in this 1970s situation. And a lot of the talk about too much stimulus in the short term is really, more political than anything else. It's about people who don't want to spend money and people who basically don't want to pay taxes. There's a lot of it. But fundamentally, the long-term structural drivers of inflation just aren't there the way they were back in the 70s. And that really comes down to supply side constraints, the inability to produce enough goods to satisfy demand. We're not looking at that. Nevertheless, let's look at what bond yields are doing in the short term. Here's a chart that shows that the next anticipated rise in bond yields is going to be or trigger point would be the 2%. And we would probably see, I think, pretty significant action if we saw a 2% yield on the 10-year Treasury. Now, some people are saying, well, but it wasn't that long ago that they were at that level. Why should we worry about it? Well, remember, bond yields rise for different reasons. As I've mentioned in my reply to Suraj, people hold bonds for different reasons. The last time that bonds were in the 2%, or rather the 10-year was paying a 2%, was back in 2019. And in 2019, we did have a bit of a wobble in the market. And part of that was because people were expecting the Fed to raise rates. And so they bid up the price of bonds, if you like, or rather they bid down the price of bonds and pushed their yields up in anticipation of that. So What we have today is a similar scenario where people are anticipating something, and so they are bidding down the price of bonds. They're selling bonds, basically, in order to avoid being caught with a lower yielding bond than the rate of inflation. Now, that's a perfectly rational thing to do, but it doesn't necessarily have anything to do with the underlying value of stocks or of the economy. But it does have an effect on stocks, as we've showed. So let's just reinforce the effect that it has by looking at the relationship between the S&P 500, the yield in the S&P 500 relative to bonds. So right now we're sitting at about a 2% benefit. So basically, or rather, 200 basis points. So essentially, right now you're doing better in the S&P 500 than you would be doing in bonds. But it wouldn't take much for that to change. And you can go back to periods like 2008, when the return on the S&P 500 was significantly higher. And the return, and also that whole period during 2011, 12, 13, before the taper tantrum of 2013, again, when stocks were returning significantly higher than bonds. Right now, the relative advantage is reasonable, but if it started to tick up again, then certainly we could see, or rather, if it started to tick down, if it continues to tick down, we could certainly see a move away from stocks. Because the critical thing is that when you see spikes in that line, that's when stocks are attractive relative to bonds. And as that line falls, the situation reverses. And to go back to Suraj's point, a lot of people like to hold bonds, especially in very large quantities, because it's a risk-free asset. You don't have to price in any risk at all, really, when it comes to U.S. Treasury bonds. And as a result, that is particularly attractive. Really, I mean, not everybody is playing the GameStop game, hey, in the market, folks. A lot of people have billions and billions of dollars earning 2%, which compounds into a really nice return over time. And so don't forget that that's what tends to happen. So the big question is, given all of this, given the fact that there are signs pointing to rising bond yields, as we've been discussing, and again, they're up today. I'm recording this on Thursday. They're pushing again against 1.5% yield on the 10-year again. What does that mean for the rotational aspects of the market? In other words, are we seeing a move away from the stocks that have done well in the past, as I argued last week? Well, here's a chart that shows what's known as a head and shoulders pattern. This is the QQQ, which is the Nasdaq Trust. And remember, the Nasdaq as a whole holds a lot of companies that are not necessarily big tech, a lot of biopharma. So, but nevertheless, this is a good representation. Now, the big green arrow shows that there was a great upward trend going into the beginning of this year. Then there was a big jump in late January, an attempt to push higher that failed. And there was another attempt to kind of push it up again during February, and then another drop, and then an attempt to break above previous highs, which failed. Now, that sort of head and shoulders pattern is considered by some people to be a strong signal that we're looking at a reversal from a previous bullish trend into a declining trend. And I think that there are perfectly good reasons to expect that to be true. And so that's why I think that this head and shoulders pattern actually does reflect the likelihood that we're going to continue to see a lot of weakness, particularly in the Nasdaq 100, the big tech stocks, over the next month or so. So, fundamentally, the question is, where do we go from here? Now, I've said in the past that I think if we're looking for a rotation into cyclical stocks, which is, consumer-facing stuff, the stuff that people buy when the economy is doing well, then that's a good thing to do. But here's the problem. A lot of cyclical stocks are already overvalued. Right now, the average PE ratio for the biggest technology companies in the U.S. is 38.3 times forward earnings. That's if you include Amazon. If you exclude Amazon, which has a PE ratio of nearly 78, then basically that drops down to 28.4. Now, in non-tech, the biggest companies in the United States, the average PE ratio is 37.3, which is not all that much lower than that for the tech companies. If you exclude Disney, which has an insane PE ratio of 147.3, then you're looking at a PE ratio of 25.1, which is a little bit lower. There's a bigger gap between that and tech, which was 28.4. Bottom line is you need to be judicious about which value companies you jump into. And I'll come back to that in a moment. So yes, I mean, definitely you could go in looking at consumer companies. You could look at companies that are going to benefit from a rising economy, the post-pandemic economy. But as I'll show you, you've got to be careful about which ones you pick. Okay, next thing we want to talk about is what the Fed is likely to do. There's been a lot of talk about Operation Twist number 3. Operation Twist is related to what I spoke about in one of my recent videos, where I talked about how the Fed could actually intervene to buy long-dated bonds out of the market to raise their price and also increase their scarcity, and then sell short-dated bonds in order to drive up their price to sort of flatten the yield curve. The Fed has done this twice before, once in 1962 and one in 2011. Now, look at what happened in 2011. Basically, 10-year yields dropped from 3.75% in February 2011 down to a low of 1.43% in July 2012. That's more than 200 basis points. So that just shows that the Fed can actually influence the yield curve and particularly bring down long-dated bond yields if it wants to. And that's irrespective of inflation expectations. Again, a lot of people are talking about inflation, but I think they're, in a sense, using that as an excuse for an overdue rotation away from overvalued tech stocks. So if the Fed did decide to do that, they'd obviously be doing it because it's better for economic growth, and it's kind of like a stimulus package, really. You're trying to encourage people to take on longer dated debt so they can fund current economic investment. So I still think that that's a possibility. So what are the takeaways from the perspective of an investor of all this? Well, here's a chart that shows the relative performance of the Nasdaq 100, that's the blue mountain, versus XLF, financials, XLE energy, and PEJ, which is a proxy for consumer expenditures, and particularly things like travel, leisure, and entertainment. Well, as you can see from the beginning of this year, there really has been a significant pull away, which really picked up, accelerated at the sort of mid-February, and we're seeing a very significant divergence between the top tech stocks represented by that blue mountain, and particularly energy and consumer discretionary related to travel and entertainment. So clearly this rotation is already happening, and it's consistent. It's been maintained now. I think if you look at it from the perspective of, let's take 1 February as the starting point. We're now into over a month of this. The question is, if you're going to take advantage of this rotation, what are you going to do? Well, don't buy Disney, because Disney's 147 price to earnings ratio suggests that it's already overvalued. In fact, given the fact that all those big consumer companies are already overvalued, relative to, or at the same high valuations as tech stocks, consider some of the ones: Berkshire Hathaway, JP Morgan in finance, United Health, Home Depot, Verizon. A lot of these companies are, they have reasonable valuations, but you need to also consider whether they have great growth prospects. Bottom line is you need to be very, very judicious about which stocks you rotate into if you are taking money out of tech stocks. And that means looking at companies that have genuine competitive advantages that are likely to do well, not only in terms of increasing revenues, but increasing earnings. In other words, their ability to ramp up supply doesn't come with an increase in costs, so that they end up not making that much more money, even though they're selling more goods. That means paying careful attention to fundamentals, which is something a lot of people have forgot how to do recently. So that's my first message. Prepare for rotation. Look for genuine value, right? Look for companies that are genuinely going to deliver higher earnings over the next 3 to 4 quarters, so that the market will trend them higher. Second thing is, it's probably not a good time to try to buy the dip in the high-flying tech stocks. This may be the dip that sticks. I know that a lot of people like to make fun of me for talking about these things, predicting these things. But honestly, if you look at all the factors, it's very hard to argue that you really have much more for the high-flying tech stocks to go. They're high enough already. They're like jet engines. They're running out of oxygen, and so they can't fly any higher. They can maybe maintain a level, but that's not why we invest, right? We invest for gain, not to maintain a level. So that's the second thing. Don't buy the dip, I think, right now on the highest flyers. The third thing is don't write off tech stocks. Just make sure that you buy tech stocks that have strong secular tailwinds. And for me, that means renewables and EVs. And again, you need to be judicious. I recommend buying companies that have genuine growth prospects in the near term. And that means staying away from the brand names and the hype names like the Nikolas and so on, which are really more about a branding exercise and a startup mentality. Focus on companies that are actually doing interesting things, attacking market niches that a lot of other people aren't aren't paying attention to. For example, everybody's talking about commercial delivery vans, but there are other types of large fleet vehicles, like the post office. We just bought a bunch of vehicles from Oshkosh, although probably too little in terms of EV. Those are the kinds of things that often present the biggest opportunity. And so I would say, when you go looking for tech stocks, don't just look at the names everybody else is looking at, the meme names, the Reddit names. Look for the companies that are doing interesting things in interesting sectors. And on that score, I have a bunch of them that are coming up that are already in the Bauman letter and some more that we're about to add. So anyway, that's all from me this week. This is Ted Bauman signing off, and I will see you again next week.